Have you ever felt that irresistible urge to join in when everyone else is doing something exciting, even if you are not quite sure why? That powerful human tendency to follow the crowd does not disappear when you step into the world of financial markets. This phenomenon, known as herding behavior, is when individual traders ignore their own analysis and independent information to instead follow the perceived actions of a larger group. Recognizing herding behavior is crucial because it often leads to irrational market movements, creating bubbles or sharp corrections that can significantly impact your trading performance. At its core, herding behavior stems from deep-seated psychological biases. One major driver is the fear of missing out, or FOMO, where traders jump into a rising asset because they see others profiting and do not want to be left behind. Another factor is social proof, the belief that if many people are doing something, it must be correct. Traders might also assume the crowd has superior information, even when evidence suggests otherwise. This collective psychology can override rational decision-making, pushing prices for beyond fundamental values. You can identify herding behavior by observing several key market signals. Look for sudden, parabolic price movements in an asset that lack clear, corresponding fundamental news. Pay attention to a dominant, widely accepted narrative that justifies these price increases, often becoming louder and more simplistic as prices soar. Watch for unusually high trading volume during these steep rises, but critically, notice if selling volume remains relatively low even on price declines. This suggests few are willing to exit, holding onto the hope of further gains. Finally, consider if market participants seem to be abandoning traditional valuation metrics or risk management principles. It is important to differentiate between irrational herding and informed collective action. Informed action is when many traders independently reach similar conclusions based on solid analysis. Herding, however, is often characterized by a lack of individual due diligence and an over-reliance on what others are doing. Sometimes, the most profitable opportunities arise when you are willing to go against the herd, acting as a contrarian, but only after your own rigorous analysis confirms the market consensus is flawed. By sharpening your awareness of herding behavior, you equip yourself to navigate market volatility with greater discipline and independence. This allows you to avoid being swept up in speculative surges and protect your capital from subsequent corrections. Ultimately, it empowers you to make thoughtful, strategic decisions that align with your trading plan, rather than succumbing to the emotional tides of the crowd.